I'm Michael Fox, and this is the Prospector News Podcast. And I have joining me today returning guest Mike McGlone, Senior Commodities and Analyst at Bloomberg Intelligence. Welcome, Michael.
Well, hello, Michael. Thank you for having me back.
Yeah, we got a little formal there. We usually call each other Mike, but it just seemed like a bit of a formal day, so I kind of went down
Hmm.
that road. We've had a good chance to see how things are going in 2024. We've gotten half the year kind of behind us. The commodities were pretty exuberantly happy through the most of the part of the first half of the year, but they seem to have been correcting here through July. We're here on the last day of the month, and I thought it'd be a good time to get you to come on and let's take a look at what's happened this year so far, why it's happened, and then what we expect to happen in the back half of the year.
Well, let's do it. It's a key point you made is the Bloomberg Commodity Index was up about 12% to its peak. I think it was in May, and it's as of we're recording on July 31st, it's dropped. It's given back all those gains, and it's even industrial metals are up about 24%. They've given up all their gains. It bounced a little today, but overall, to me, the tilt and the momentum in commodities is toward more deflation.
Now, is that the traditional seasonality arriving late, or is there something else afoot here?
I think the word you use is traditional. It's typical. It's normal for commodities to probe for the low price cure after getting too expensive, actually too hot to the peak in 2022. And then you have to rope in China. I like to point out that Chinese 10-year note bond yield at 2.15% is the lowest in our database since 2006. It's basically 200 basis points below the US. So there's severe deflationary forces coming out of China. We all hear from virtually every importer of anything to do with renewables on the planet is doing everything they can to push back from those deflating sources from China, which is part of a major deflationary source of demand for petroleum. It's basically being replaced by technology, and it's not seeing that demand for copper or industrial metals as you'd expect in an expanding economy because they're not. You can't really trust your data, but it's kind of hard to mess with the bond yield. It's math, and even from my colleagues who are based in Asia and Hong Kong. Stephen Shu's one of them pointed out that Chinese government trying to do what they can to increase bond yields, but there's a major flight to quality there. So that to me is a number one indicator to watch. And also we've seen the U.S. stock market. It was at the peak this year. Total return was 20%, and that was on actually July 16th. Now we've had about a 5% correction. Every time you get pullbacks, markets always say, "Oh, it's just a healthy correction." And I'd like to know any peak in any market in history that wasn't a healthy correction. I remember reading about that in 1929 and 1930, and certainly in 2000 and 2007 and 8, and it's always happens that way. So I do enjoy that, but the problem is equities are so expensive, 2 times GDP. There's so many metrics I look at. Volatility is so low, and my metrics are U.S. VIX volatility, the 52-week moving average minus the T-bill rate is the lowest since just before the great financial crisis. So you have to, from a commodity standpoint, the way I look at it is as of now, we speak the S&P 500 total returns about 17%, and I think it's normal years 8. So there's a lot of room for it to revert, but the market's not prepared for that because that means severe deflation, and we're already seeing commodities. So for broad commodities to go up, you have to have some prerequisites. One of them, first of all, is the stock market has to go up. That's the U.S. China has to see some form of increasing pickup or surprise shift to demand pull forces. And we all know the whole world's doing everything they can to get out of China to reduce their imports, certainly US, and maybe a weak dollar, which is, a weak dollar in a strong stock market has been an oxymoron since that bottom around 2011. So let's tilt over to a major space you really like to focus on. That's metals. Looks like copper put in a pretty good peak around 5. It's dropped to 4. That's pounds. It meets a good support. But the key fact is gold. Gold on the year is up almost 18%. On a 1-year basis, it's up 23%. It's beating that AI-driven S&P 500. You don't hear about that every day in the press, but I expect that to continue. And industrial metals, that were up a lot in Europe, basically now flat in the year. They've given back all those gains. And I think the risks for the rest of the year is that these deflationary forces from commodities, these recessionary forces from commodities, i.e., even energy index is down in the year after being up about 15%, and gold's the only major commodity that's up. That's a major global recessionary trajectory. The key question you have to ask yourself is what stops it. To me, the main risk is we accelerate those trends, and they're really normal following the biggest pump in liquidity and the big pump in prices on the back of the Russians' invasion of Ukraine. And now we're in the hangover mode. It's just a question of how long that lasts.
So you're anticipating then for the back half of the year that most of the commodities are going to go into a deflationary period, with the exception of gold. Is that my way to take it?
Momentum's heading that way right now. When you wipe out gains like that, you need some form of significant gains in broad commodities, exception of gold. You need some form of significant catalyst to reverse those gains, and it's normal for commodities to revert when they go too high, and they went way too high to that peak in 2022. So I expect that to continue. I'm looking for forces that might end it. Now, maybe some form of supply shock that would have really pump up crude oil, some kind of geopolitical issue. But we're finding out that all the escalation of Cold War 2.2, that's 2.0, that's getting hotter and hotter, it's not reducing the supply of crude oil. It's actually reducing demand and increasing supply, most notably from the U.S. and Canada. The excess supply in crude and liquid fuels out of the U.S. is just massive, and it's increasing. It's way offsetting what the excess of production it's increasing out of OPEC. So there's an issue there. The key thing is I just penned my piece, published my outlook for August for Bloomberg Commodities, and I point out that you can blame America. I mean, we have an excess of supply of agriculture and grains, excess supply of natural gas, excess supply and Canada, excess supply of liquid fuels, and you have to depend on exports to balance the market because we have declining demand. Unleaded gas demand in the U.S. is flat to declining. Diesel demand is down, well, almost the same level as 10 years ago. Paperboard, containerboard demand, all these indicators I have are really heading downward. They really, really contribute to, I think, complement the inverted yield curve, the fact that bond yields are potentially going to follow China. And I just look for catalysts that might reverse that. And right now, I see the biggest risk for everything is just a little bit more back and full in the U.S. stock market. And that means the deflationary dominoes tumble. And, when the Fed, we're meeting today at Fed Day, we know the Fed's going to be basically 100% chance they're going to cut 25 basis points at the September meeting. And they kind of have to. I mean, yes, inflation is still sticky, unemployment's still strong, but the bottom line, I'll end with this, is U.S. unemployment at 4.1% is bottom at 3.4%. It's heading higher, and we've never bottomed from such a low level without going to 6%. And every single time, there's fiscal and monetary stimulus, but it always goes up to 6%. The key question you ask yourself is, what stops that? I'm more worried about things that might accelerate that normal process of cycles in free markets.
So not that soft landing that the Fed's been praying over for the last several months.
We've had it. That's the point. We've had the soft landing, and interest rates, as we speak, are still above 5%. That's 3% above the annual PPI. It's 2% above CPI. Those are very restrictive levels. But the Fed gets it. They know, they see how elevated the stock market is. On the way up versus GDP, it's the most elevated since 1929, basically 2 times GDP. In our history, I just went back to, if you just look at the peak, when it peaked at basically 1.3 times GDP in 2000, the average since then has been about 1-to-1 versus GDP. So there's so much excessive speculative risk there, and so much, to me, the only thing when people talk about inflation, the only thing that's really going to matter for inflation if the stock market keeps going up, and the key factor for deflation is if the stock market just reverts a little. And I don't really mean decline, just normal reversion, which is stuff that always used to happen. And I just look for signals, triggers that might signal that, or anything that might stop that from happening. And I'm worried that just the normal cycles are going to tilt that way. And commodities are all showing that. So I just look at my commodity dashboard for the year. Gold's up for a 1-year basis. Gold's up 23%, and a Bloomberg Commodity Spot Index is down 7%. That's a clear recessionary trajectory. And I look at all the other major commodities, industrial metals, industrial metals are down on the a 1 year basis, are down almost 2%. That's just not good when the rock is beating stocks. And the fact that most people don't get it yet means, oh, and here's one key thing I'll end with. That's a key thing I want to point out about gold is gold ETF holdings have finally shifted upward. It looks like that's a bit of a sustainable trajectory because outflows in gold ETFs have been significant for at least 2 years now.
Yeah, one of the things that I've been noticing over the last several months is that the commodities markets, if not the stock market, have been signaling a recession's coming. And what causes me pause of concern is that you don't hear people talking about the recession. It's kind of almost like an Alfred E. Newman, what me worry kind of situation. And those are the times when you should be worried.
Exactly. So first, as we speak, we just got the latest headline from the FOMC. The statement shows no change in rates and dovish comments. So markets, it's just basically what we had expected. And I'm just looking on the WIRP function on the Bloomberg terminal and shows that they will be cutting rates 100% chance at the September 18th meeting. But that's the key thing. It's the quote from Benjamin Disraeli, the former prime minister of England, who pointed out what we anticipate often does not occur. And that's what's most significant. We're basically going through one of the best examples, I think, ever. We're going to look back at this from the future of human nature and shifts in sentiment, where a year ago, the sentiment for a recession was way too extreme. I was wrong. And then we flipped back just within it was actually only a few months ago towards absolutely zero chance of recession. And now the pendulum's just swinging back a little bit. But that's when the opportunities come in markets. When it's widely anticipated, look for alternatives. And that's where I come from. I'm used to working at hedge funds and working with hedge funds, and it's the hot money that matters. And I anticipate the next big trade, next big potential position will be U.S. Treasury long bonds. Right now, look at the 10, 4.13%, catching up to China at 2.15%. In the typical normal recession that's been way overdue and delayed, it's been predicted by the inverted yield curve that everybody gave up on, and then it's going to potentially go down in history as a pause that refreshes. So this pause is what I'm concerned about, and I see all those signs from commodities. And the key thing is, like I might have mentioned earlier, is that we are seeing pretty significant declines in demand for diesel and unleaded gas and container boards. I love using container boards. I have a colleague who tracks it closely. Corrugated boxes. And it's all showing up in things like gold outperforming almost everything, and certainly on a risk-adjusted basis. So I'll end with this. I think from a commodity standpoint, one of the best things to look at for indications of where things are going are the grains. They're the most elastic, certainly in a supply standpoint. And we have an overhang of supply from last year, most notably in corn, and that's not just in the U.S., but a lot of its production has been coming from Brazil, and definitely a lot of production up in Canada. And we have one of the best crops ever brewing in the U.S. It's August in a day. Corn has basically been made. It's been done. It's made in July. It just has to dry out now. And then the rest of August is really for soybeans. But I was out in the heartland, where I'm from, a few weeks ago, and I've just never seen it as green and lush. And I expect we're going to have massive bin busters, which is an indication of there's one main reason we have in that is because prices went so high when Russia invaded Ukraine, and when we had unlimited, that massive liquidity pump, they're all tilting back downward. And that's the lessons of what I like to point out to people of all the history books I've been catching up on the last 2 years. That is, when you get these massive liquidity pumps, they always dump, and asset prices always dump. And it's just a question of when and how. And the U.S. stock market is basically holding up the world. So let's look at it this way. Say if the U.S. stock market just drops down to a normal year up 9 or 10%, by the end of the year, that's a significant deflationary trajectory because people are not set up for it.
No, they're not. And we talk about the possibility of something else happening that would toss this all into a blender and throw the cards up in the air. And we kind of maybe got that this morning with the assassination of the Hamas leader in Iran. Is that the potential to cause that conflict to spread throughout the Middle East? And what does that do with the oil price deflation?
Well, okay, that's one thing. Let's first talk about the oil price deflation, because that's what it's doing. It's just reverting back to its cost of production. In the U.S., it's $55 a barrel. Tar sands in Canada, it's closer to 60. It's just a matter of time it gets there, because that's where the major supply-demand imbalance of the world that's been pressuring prices since 2008 is coming from. You need some form of sharp, significant delayed supply shock out of the Middle East. Otherwise, this is going to continue. Yet, what you're seeing is, I think, a revival of Cold War 1.0, and it's getting hotter every day, which to me is one thing that the equity markets haven't priced in. Part of the reason the equity markets have done so well since the fall of the Berlin Wall is because we've had a significant, and the collapse of the Soviet Union, a significant period of détente on a global basis. That's completely shifted with the decisions of two people, President Xi and President Putin. Most notably, President Xi. President Xi, the leader, the autocratic leader of China. I just can't wait to write the textbooks about this, Michael. That what it's like the perfect storm to destroy, for reversion of a rapidly growing emerging market. So let's think what he did. Well, let's just piss off my best customers by, as the NATO said, by being a significant enabler of a war in their backyard. That just doesn't get better than that. And at the same time, we have a severe property crisis. Every time I type on the terminal BI China or NI China, all my colleagues just point out this property crisis is as bad as it was in Japan, just 5 times as big in terms of GDP, as bad as it was in the US to the peak in 2006 when property crisis peaked. And maybe, there's so many other examples in history. It's just getting started. So the global situation to me is very much bearish for risk assets, yet they haven't figured it out yet. And I hope it works out fine. I think gold's figuring it out. Gold's a risk-off asset. Bitcoin in that space has usually been, as people call it, the fastest horse in the race, has been lagging, I think, significantly because it's a very much of a risk asset. It's the world's going digital, but it's much more volatile than gold. So the way I see the world going into the end of this year, if we can get through the year without too much significant hot wars flaring up, too much significant things that might really affect sentiment, and of course all the horrible death and destruction, but we'll probably be okay. But we all know it's going. You need some major shift in its sentiment from President Xi initially. He needs to push back on President Putin and say, no, the unlimited friendship's not working. That's not going to happen. Then we have this U.S. election brewing. And I think what's tilting now is we had a little brief moment of what things would look like if President Trump was elected. He's after the assassination attempt, his polls went up to 70%. Now they're back down to 50-50. And I think people are seeing there is one alternative to incumbents. President Trump is incumbent, and most people know and have to be careful about if you vote for him, you're voting against the rule of law that makes this country great. But there's this alternative of Mrs. Harris. And if she wins, which seems to be 50-50 right now, that is quite the unique situation because the market had pumped up equities and have pumped up for Trump and might not lose that. But one thing I'll point out is that it might not just be as fluid and simple as one or the other the morning after the election, a known. It could get a little sloppy.
Yeah, cue back 4 years ago, and then we see what sloppy looks like for sure. The one thing that I always found interesting is the argument that President Trump is going to be good for the economy and therefore good for the commodities, where I saw it a little bit differently in that he seems to be opposed to the green commodity movement. Therefore, I actually see him as being bad for commodities, with the exception of maybe oil.
Oh, I agree with that statement, with the exception of oil. Drill at will is almost certain. I think the highest probability of him getting elected is much more. He's very favorable to petroleum production in the U.S. So drill mill means more supply of the U.S., the largest producer in the world, and the major supply and demand imbalance increasing. I mean, demand is declining in this country, notably for diesel, which is really bad sign for the economy. And the tariffs on increased tariffs in virtually all of the 100 or so countries that have trade surpluses at the U.S. I mean, that's somewhat is justified. It's getting to the point in this country where people have little concern for, all these NAFTA agreements and stuff, because I think economists are realizing when you own the world reserve currency and it's strong, you're always going to have a problem with trade deficit. So push back on that. So that's bad for everything economically. And it, it has it's similar to the Smoot-Hawley Tariff Act in the 1930s. But I think the bottom line to me also comes down to the dollar, and that is he's made it clearly a statement as wants to help U.S. exports, and that means a weaker dollar. So I have a colleague of mine who wrote a book called Paper Soldiers, and my conclusion is if he's elected, it's probably bad for the dollar, and also his pushback on the rule of law and the Federal Reserve. All that's somewhat bad for the dollar. But which might be good for asset prices. But overall, I think the problem is the market's pricing so much enthusiasm. When you look at, again, the bottom line, the U.S. stock market's 2 times GDP. It's like the highest it's only been up above this level for a couple days in the last 100 years. So it's pretty expensive. I look at volatility. VIX volatility index is buried. Interest rates really high. And then there's so many other measures that point out the U.S. stock market is due for a little bit of back and fill. And whether he's elected or not, it might just be the trigger that does it. Because I think when you price for something that happened before with complete confidence, as we know, Benjamin Disraeli warned us, it typically doesn't happen that way. So I just look at it as equity risk assets are so expensive. To me, that's part of the reason gold is doing so well, obviously with the war brewing and China buying a lot of gold. And I think the biggest potential shift in the next few years will be normal deflation, which means gold and U.S. Treasury long bonds could be some of the top performers.
And what does that do for commodity miners?
It depends on how they manage their businesses. And on the miners, I think I'm quite concerned, the underperformance despite, significant strength in gold. But overall, those are equities. And if beta is going down, that means it's bad for any type of equities typically. But I just don't cover that space as closely as some of my colleagues. I'm more concerned about the overall, I would say, deflation worthy of the inflation that we got to the peaks in 2022. It's a normal thing for that to happen, and all I see from commodities is that going that way. And it's been enjoyable how it's been happening too, because there's so many people with their models, smart quants on Wall Street who just didn't open up the textbooks, and they're realizing WTI crude oil at 78 makes a lot of sense. The problem is it's still maybe in some cases almost 40 to 50% above its cost of production in the major producers in the US. That means it's probably going to get there. Natural gas has already done it. So from a commodity standpoint, with the exception of gold and maybe some metals, I see just normal deflationary forces potentially accelerating. And again, it comes down to by the end of this year, if the stock market's down from these levels, those forces will be pretty severely significant. And then look at the Fed. Now, what did they do? We have the first time in history, the most significant rapid rate hikes in history. What they did is they went up on the elevator. Typically, they do the opposite, and then they go down on the elevator. So I think rates are going to go down on the escalator. And the problem is, I don't think we're going to see the Fed's normal deflation measures go down until the U.S. stock market goes down, cuts off all this speculative buying and wealth effect, and creates that normal deflation you expect when prices go too high. So commodities are indicating that. What does it show? I'm looking for something to show me something different. And this move in copper this year, I thought was quite significant. We had managed money net positions in futures, and both LME and CME coppers got to the most extended in, 6 years, I think? Way stretched. Over 30% of all futures positions were speculators net long. So it pumped up copper to $5.20. Now we've bottomed down to around 4. We've bounced from 4. But overall, those speculators are still about 20% net long. That's way long. Typically, bottoms in copper come when speculators get down to 5% of total open interest, which means, $4 copper should hold for a little while. But just looking at China, looking at the risks in the U.S. stock market going down, yields going down, China in decline as measured by yields. It looks to me like the risk to copper as it does it. It's put this way: copper is becoming more like the devil's metal silver. It goes down because it went up, and that spike to the new highs we had this year is very suspicious.
So given everything's looking for recession soon, is it short and shallow, or is it long and deep?
Well, that's the thing. It will be the latter, I think, particularly if you just look at the lessons of history. And the typical human nature, everybody, once it does start, and it will, it's just a matter of when. Obviously, some of us were too early. The first thing everybody will say is they'll be able to short and sell. It's normal. It's human nature to say that. Just like when the stock market first starts correcting, oh, it's a short correction. It's always just a correction. It's healthy. Just way humans are. But the rational, I think, smart investors in the world realize that if we have what's normal, a normal worthy cycle of the biggest liquidity pump in history, and then this sharpest rate hikes in history, and then of course the reversal in the detente of Cold War One going back to Cold War Two, then we should just do what we normally do in terms of how the recession is going to go, but just get that stock market back to 1-to-1 versus GDP, which is a lot. Because that's the problem. It's so far. People get so accustomed to this wealth effect that lessons of human nature and history is the biggest, most powerful force in markets and mean reversion. It's one of those things I don't say lightly. I hope it doesn't happen, but I'm making basically somewhat of a prediction of a lifetime. But everything's tilting that way, and you cannot have people agree with you, or it's already too late. It's already happened.
Yeah, that's and unfortunately that's the reality is everything's fine until it isn't.
Yes, well, that's the key thing. It is until it isn't. So far, we're seeing the classic signs of stock markets. Basically, betas dropped about 5% from the all-time high. Um, it's everything I hear is, yeah, it's just a normal, healthy correction, and it's always buy the dip. And at some point, you have to point out, okay, if everybody says buy the dip, and they've been saying buy the dip for 11 years, at some point you got to run out of fuel if you're always just buying the dip and never selling something. And that's always the way it happens. So to me, it's more psychological now. But the valuations, the measures are just so extreme that I think the smarter, more prudent investors are just looking over at that T-bill at 5% and treasuries, most of them are still above 4%, and saying, yeah, okay, that looks pretty good. Hey, I'll end with this. If you look at the average of the five top countries in the world, their 10-year note yields, that's China, Japan, Germany, UK, and India. Their average is 100 basis points. Their 10-year note yields are 100 basis points less than the US 10-year note. Before the financial crisis, about there, they were closer to 100 basis points above the US. So that's just how attractive US is. When people talk about increasing deficits, I'm like, yeah, well, what country's doing much better on that scale?
Yeah, that was one of the comments I was about to make is that, the US dollar is remaining strong in spite of recessionary pressures being put on the economy, just simply because their interest rates are, you know, higher than everyone else, and everyone else seems to have started cutting in advance of the Fed making movement in the US.
Well, I like that statement because, first of all, it's the US dollar versus a basket of other currencies or specific currencies. They're all fiat currencies, they're all flawed. Which one is the least flawed? Well, you get 5% in the US and the rule of law, except if we get Trump again, we know the rule of law will be pushed back maybe towards Venezuela, but maybe cooler heads will prevail. But it's just unstoppable force at the US dollar versus other fiat currencies. Now, the US dollar has been declining versus gold, and I expect that to continue. It's been declining versus the stock market. I expect that not to continue. And that's one key fact, and that's really concerning about the whole big macro space. Certainly since 2011, the US trade weighted broad dollar has been almost increasing almost tick for tick with the US stock market outperforming the world. So now we're at the point with the S&P 500 versus the MSCI ex-US index. It's the highest ever. U.S. stock market's the highest ever versus housing. It's the highest ever. It's the highest in 25 years versus the Bloomberg Commodity Index. So it's a bit stretched. So there's that conundrum. For a weaker dollar, typically it's probably going to mean weaker stock market, which means if beta goes down, everything has a drag to beta. Now, to get commodities to go up and beta go down, typically will mean some form of supply shock, which we all know is probably not a good thing.
No, those definitely aren't. Now we spoke off before we started recording this. Both you and I got out of our bubbles in the last little while and kind of visited Main Street America. You'd mentioned that you'd been in the Midwest, where you're from originally. I took a trip to Boston. Where I tell you, when rubber hits the road, I was seeing recessionary signs on Main Street for sure. I did a little bit of tourist stuff. We went out for dinners, caught a Red Sox game in Fenway. Yeah, Fedway's always sold out, so that's not necessarily a good gauge. But we had no problems getting into restaurants. The restaurants we chose weren't, run of the mill where you just expect to walk in off the street kind of restaurants. You needed reservations. We were able to get reservations on short notice. The restaurants themselves weren't full. When I was playing tourist, I noticed the tourist buses going around me. They weren't full either. They were, maybe half to two-thirds full. Um, all these, suggest to me that the American consumer doesn't necessarily have the extra funds to be out traveling and going out for dinners, etc. What did you see when you were in the Midwest?
Well, the main thing I noticed is I remember in 2006 and 7 being somewhat I was very bearish because I saw the signs, and yet I lived in Fairfield County, Connecticut, which was right by New York. I mean, it's a suburb, and I never didn't really see signs of contraction from consumer spending until after the stock market went down. Then it was so clear. The main thing, my main takeaway from the Midwest was just the lushness of the crop, which is kind of my background when I go there. I mean, the key thing you look for in August is the tassels of corn. When you look from above, you can see just an ocean of brown tassels. And typically it doesn't come till August or September. I've seen it happen in July. So, and I did not see it. Just if there's any issues, it was too much rain, which has never been an issue because it just means low spots underperform. But so that means major pressure on grain prices. Now, the thing is, managed money net positions, futures already set up for that. They're way almost record short this year. So, okay, we might see some bounces, but the anecdotal stuff is backed up by what you're seeing in credit card data, record nearing 10-year highs in delinquencies. And I just look at demand for diesel in this country, which is more industrial, is just it's never done this before. It's unchanged on a 10-year basis. It's down 5% from the peak. And in expansion, everybody tells me, oh, it's different in services this time. I see demand for unleaded gas. It's flatline. It's way down from the peak in 2019. And then you see this major shift towards every country in the world is doing, almost every country doing everything they can to increase tariffs and restrict exports of renewable type vehicles, solar panels, anything to do with new energy out of China, which means major pressure. I mean, just look at the latest IFO data out of Germany showing the pressure on all these economies. And I look at it as the Chinese consumer is and economy is way overdue for normal depression. And what Mr. Z did with his unlimited friendship maybe just created a little fuel for that. The US and Canada and the rest of the world, all part of that normal cycle. And the key thing that happened in this country is we just pumped and threw so much money at people, and it's been spent, it's gone away. And what does that do in the meantime? It just pumps up assets. It gets people accustomed to this lifestyle. They can only live off their credit cards so long, and it typically tilts back. And I just point out Fed funds are still above 5%. CPI, it's still 300 basis points above CPI. Typically, the average the last 20 years is Fed funds are 1% below. I'm sorry, PPI, whichever one you want to pick. And I look at it as the dependency for the U.S. stock market to go up is so great that there's certain times you're supposed to just look to other alternatives, and I think that's what some of the smart money is doing. But from a consumer standpoint, it's certainly clear that the data shows people are cutting back, and that's certainly from a lot of the retailers.
Well, you take all those factors in a toss election in November. Interesting times ahead of us for the rest of this year.
Interesting, but I think there are tremendous opportunities for the more tactically oriented. I think it's for those who are way overweight equities and expect to make more and more money and increase their wealth. Be careful. But from more tactically oriented, which is more my focus typically, these are tremendous opportunities. The key thing that I'm really concerned about, I remember making this statement in 2000 and 2007, is everybody's in it for the long haul, as long as beta is going up. We have to remember that. You hear that always so much at extremes. Oh, I'm in it for the long haul. And everybody is, as long as beta is going up. And that's when you get those shifts in history, for a good reason, where we find out that beta just doesn't go up unstoppable like this. Like it was up 20% at the beginning of the year. Now we're up only 17%. And just imagine a great year. It's up still only 10% at the end of the year, which means we would be going down from here. And that would be the psychology of that, I think, would be it's getting to the point where the market can't really take that, even though it wouldn't be so bad. But that, to me, that's the tilt we're going to. We have to have that stock market here or unchanged by the end of the year, or the sentiment, I think, is ready to shift.
Well, we'll see what the end of the year brings. If people want to follow your musings, how's the best way to do so?
Well, I'm on the Bloomberg terminal first. It's not everybody can access. I post on LinkedIn and Twitter every day. I put mostly little like cliff note versions of what I'm writing about, the major thoughts. And if they want to reach out to me via a LinkedIn or Twitter, and I'm happy to add them to my distribution list.
Yeah, and
And
you
on
get
your program.
Yeah, well, absolutely, and we get that generally daily, and there's always good information in that. So, and it goes across all the commodities. So, it's been a pleasure having you back on. I look forward to having you back on again in the fall, and we're going to watch how this back half of the year plays out.
I'm looking forward to our next conversation, Michael. I'm sure there'll be a lot of interesting things. We'll see how it works out.
Well, that's been due for the course of the last couple of years. There's never a shortage of things to talk about. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.